Spring has come early this year, and risk assets too are flourishing. Surveys and flow data, however, are telling us that investors have been cautious and haven't strongly participated to the rally. As they catch up and climb the wall of worry, risk assets should continue to benefit for now. The panic around Christmas was focused on China and Europe. We've seen better news in China already. Lending in January was huge and reminiscent of the strong policy reaction in early 2016. Data in Europe has remained poor, and investor surveys highlight fears of a recession. We are confident it will be avoided. Some of the previous drags, such as higher prices and euro strength, are dissipating. Also, wages are rising faster than prices, and that's great for the consumer purchasing power. The markets face a very busy agenda over the coming weeks. We're confident that the US-China deal, the National People's Congress, and the ECB meeting are all positive triggers, though they've been priced in partially. We're also confident that a crash Brexit will be averted. Some risks remain, of course. We're not losing too much sleep on the US debt ceiling, but trade tensions between the US and Europe do support equity portfolio diversification away from Europe. One key driver of the risk rally has been the U-turn from the Fed. Some will say that Powell has yielded to the pressure from Trump. I don't really subscribe to this point of view. Instead, the Fed is adjusting to softer data outside the US, but also inside. For example, home sales have been slow. The Fed has also reacted to tighter financial conditions and, most importantly, low inflation. Wages have picked up, but core inflation is stable. Inflation expectations are dormant. Consumers expect inflation at 2.3% on average over the long run, the lowest ever. This is most unusual in such a late phase of the cycle, and will be front and center in a Fed conference in June. This forces the Fed to think outside the box in terms of what could be done if and when the economy slows. The Fed is not alone. Inflation is not reacting to higher wages in Europe either, making it harder for the ECB to normalize policy, though bank stocks are screaming that the negative rate policy must end. In all, we recommend to surf the risk-on wave a bit longer. Potential for stocks is limited, but you don't want to miss out on the unwinding of excess pessimism. We're going through a mini Goldilocks again, with risk assets rallying, but bond yields staying very low. That decoupling is very positive for credit, as both the higher risk appetite and the hunt for yield support the asset class. We have a tactical overweight there, especially in Europe, where compression has been slower than in the US and credit has lagged other risk measures. Good investments. Speak to you soon.